Okay, good morning, everyone, and welcome to what is now the 60th edition of the Coffee Microcaps Morning Meeting. My name is Mark Tobin, the founder of Coffee Microcaps. For anybody who's joining us for the first time, you're very welcome. I've got a couple of quick slides we're going to just run through, and then we're going to get straight into it with our first presenter. I'd like to give a shout out to our sponsor for these virtual events, DMX Asset Management. If you're looking for a fund manager with an offering of smaller microcap funds, I'd encourage you to check out their website and their fund offering, and you can grab a PDS from there. A quick compliance and disclaimer slide. Just running over the companies we generally have presenting here. If you're joining us for the first time, they're generally capped under 300 million in revenue and approaching cash flow break even, or ideally already profitable. We generally don't have stocks here from the resources and biotech sectors, mainly because they're generally not in revenue. And what I like to call industrial microcaps, and that can be microcap technology, microcap healthcare, microcap consumer goods products. It's a kind of a catch-all term for everything excluding resources and biotech. Just a quick run through the structure for this morning's event. Each company, we've got 4 presenting, a 30-minute slot, which is roughly broken down to a 20-minute preso and 10 minutes of Q&A. If you do have any questions, please type them in the Q&A box rather than the chat function. Just makes it easier to moderate the questions to our presenters. And please note that this is being recorded and it will be posted on the Coffee Microcaps YouTube channel tomorrow morning. So if you want to watch back one of the presentations or you can't stay for the full 2 hours, you can catch it tomorrow morning on the YouTube channel. You can follow Coffee Microcaps. We're pretty much on all the socials, Twitter, YouTube, LinkedIn. And I also write a weekly paid subscription newsletter where I profile one interesting ASX microcap stock every week, and you can grab that off the Substack platform. I'm quickly going to hand over to Dean Taylor now in a second, our CEO from DW8. Then we're going to hand over to Mark Fortunatow from Spacetalk, who's going to be second on the list. Then at 10 o'clock, we've got Simon Morris joining us from Genetic Technologies. And then rounding out this morning's event, I'm delighted to be welcoming back Tony Abrahams from AI Media, who presented about 4 months ago, the end of October, I think. So without further ado, I'm going to stop sharing my screen. And Dean, if you want to start sharing your presentation, I'll let you know when I can see the cover slide coming through. It's coming up now. Yep, there we go. Looks good.
Fantastic. Great. Well, listen, thank you very much, Mark. I really appreciate the opportunity to present in this forum. As Mark said, Dean Taylor, I'm the founder and CEO of DW8. We are a technology company and we operate an integrated trading, payment and order fulfillment platform that primarily services the beverage industry. And I guess the purpose of our platform is really, around connecting the suppliers with buyers and simplifying their operations, and then providing them the infrastructure to provide a superior fulfillment experience. We've got a very unique technology stack, which has all been vertically integrated, servicing primarily B2B customers. And it's this vertically integrated stack that's actually key to our success, and it differentiates us from our competition. And we definitely are one of the key players in digitally transforming the local beverage market. We certainly have aspirations to take it well beyond Australia in the future. By providing a complete end-to-end solution for our suppliers, the customers, which is actually something the industry has been looking for many, many years. We have been able to position ourselves very quickly and creating Australia's largest wholesale beverage marketplace. We operate currently under 2 brands. The first of those is Wine Depot, and both brands were established a little bit over 2 years ago. Wine Depot is really, the technology platform itself, that complete infrastructure, and includes a number of components. I'll go through those shortly. As the name would suggest, we've focused primarily on the wine industry. That was, I guess, a sweet spot. I have been involved in 8 separate startup ventures within the wine and technology space over the last 25 years. So it was really, I guess, in my wheelhouse. And it was really about, I guess, leveraging those relationships to get the business sort of up and running. Very quickly, the platform caught the attention of other producers and suppliers. And we started to move into other beverages within a matter of months of launching. Caddy is a business that we acquired late last year. They launched just by coincidence, actually almost exactly the same time that we did. Their business model was really about trying to solve the same problems that we'd set out to solve within the liquor supply chain, but they came at it from a very different angle and started by launching a B2B wholesale beverage marketplace. They, like ourselves, have had incredible traction and grown very rapidly over the last 2 years. Their specialty or their niche was craft, and as all of you would have seen in the last few years, there's been an absolute explosion within craft beers and craft ciders, spirits, and even in the non-alcoholic drink sector. And for all of those emerging brands, they're more or less locked out of the market by the majors, the major distilleries and brewers. Very rarely will bring them into their distribution network unless they buy their businesses. And so they've all looked for a route to market, and Caddy's been an absolute godsend for them in terms of making their products readily available to retailers and on-premise venues. In terms of our solutions that we offer, I guess they break into 2 distinct areas of the platform, and one of those is trading, and that's where we're essentially helping our suppliers sell their products. We do that primarily at a wholesale level through our marketplace. We also provide them the ability to list their products in other consumer marketplaces such as Amazon and eBay and Vivino. We also operate a reasonably small private wine club, which is we call Insider, which is about providing those working within the industry access to, I guess, a staff drinks program where they can purchase the various beverages at wholesale prices. As a benefit of being a shareholder of DW8, we also make that wine club available and the opportunity to buy alcohol at discounted prices. The second part of the platform is the fulfillment side, and I guess the core of that platform is really the unique technology that we've developed, which we call Connect, which provides the suppliers we work with basically what is an ERP system and a whole host of functionality to help them manage their orders and their inventory and payments, and also integrations to their other softwares, such as their accounting systems and their POS systems and other operating systems. That is, I guess, all overlaid across a 3PL network. 3PL is third-party logistics, which is where we basically provide a fulfillment service for the suppliers that we work with. That fulfillment service consists of 7 depots that are located or strategically located around the country, servicing the major markets. We've got about 35,000 square meters of warehousing, which includes both cold chain, temperature-controlled storage, as well as bonded storage to service the target markets. That part of the business I'll expand on, but it's really by providing that complete end-to-end fulfillment is certainly one of the key ways that we've been able to embed ourselves into the industry very quickly, and certainly differentiates us from any potential competition. We also offer what we call Collect, which is where we actually go out to the venues, be them wineries or distilleries, or now we're actually also offering that service to our retail partners, so bottle shops and the like, where we actually collect their orders that they want to deliver to their customers, and we process them through our network as well. I guess the 4 pillars of our value proposition are all about connecting buyers with sellers, simplifying the business operations, providing superior fulfillment service, And then obviously using, I guess, the aggregated scale that we get across, sort of thousands of customers to obviously almost as a buying group and offering some of that value back by way of industry discounts. The platform that we've developed, as I mentioned before, is totally unique. There's nothing quite like it that we've come across in the rest of the world. The platform itself, the components sit across the bottom of this slide, and it consists of as I mentioned before, the trading platform, where we have a software integration module, which allows us to integrate not only our own technologies, but also with the technologies of our customers. And if you look at in the middle of the slide here, the suppliers, we have the ability to ingest their orders from their e-commerce sites through their email systems, their point of sale. They can key in their phone and fax orders. And then if they use operating software, we can also integrate with those systems or even their accounting systems. And so it just allows all of the orders, no matter what channel that they collect them from, to flow through into our fulfillment or our trading platform. The fulfillment platform is really mostly around obviously making sure those orders then get routed to the depot that is closest to the end consumer, where it gets picked, packed, and delivered by our 3PL network. What we provide to the suppliers is essentially a one-stop shop. It's a national solution. And we are one of just 3 service providers who provide that national solution, and only one of 2 that actually provides it agnostically. Anyone can come and use our fulfillment platform. One of the others, you need to be part of their distribution network before they'll take your business on. So we're actually growing in 2 different, through different manners. I guess one is the trade marketplace, and I guess that's, as I mentioned before, we're now the largest wholesale beverage marketplace in the country, and obviously also through a fulfillment platform. Apologies. So the customers that we serve, so I guess like any marketplace, it's a 2-sided marketplace. So we have on the buyer side, we have our target market is restaurants and clubs and hotels and caterers and bottle shops, and also online retailers. Basically, anyone with a liquor license has the ability to log on and purchase through our platform. That total addressable market I'll come to in a moment, but there's well over 50,000 liquor license holders in the country that would fall into those groups. We're already working with some of the larger groups, such as Fortunatow, and banner chains such as Celebrations and the likes of Bucket Boys and Applejack. On the supply side, we also already work with well over 1,000 suppliers, and I guess like any emerging business, to date, most of those have been small and medium-sized producers. And because of, I guess, the scale and the fact that we've got a national network, we have finally gotten to the point where we are starting to see enterprise customers coming on. And so much, much larger suppliers who basically recognize the potential of our network to accelerate the growth of their own businesses, we're all starting to line up and form part of our a pipeline of potential customers. Because we operate a platform business, we also benefit from multiple revenue streams. The first of those is trading revenue. And that's obviously where we take a clip of the transactions that we process through our trade marketplace, or where we syndicate that inventory onto consumer marketplaces. That total addressable market is about $20 billion. And we currently charge a clip of 5% on the transactions that we process. We also generate fulfillment revenue once the orders come through from either the marketplace or they come directly from our suppliers from their other sales channels. And that total addressable market we estimate is just shy of 200 million cases. We currently are on track to do about 1.5 million cases per annum. And that business, like the marketplace, is growing very, very rapidly as well. The third revenue stream for us is a recurring revenue or SaaS subscription revenue. And we're just in the process of commercializing that at the moment. To date, we've provided free access to our platform. Obviously, we've been very interested in obviously making it the barriers to entry low, getting people in and using the platform. But we see our software that we've developed, or the technology we've developed, is becoming central to their operations over time, and obviously been used by many businesses, but also many individual users within those businesses. And we estimate that there's well over 175,000 potential users of our software platform in Australia alone. Total addressable market, I sort of touched on this before, but there's well over 50,000 licensed venues. There's just shy of 3,000 Australian and New Zealand wineries. There's about 2,500 distributors and importers. There's been obviously an explosion in craft breweries and distilleries over the last couple of years. So there's about another 1,000 of those businesses. And obviously that's a sector that's rapidly growing. You know, collectively, it represents over $37 billion of potential GMV. In terms of our results, so over the last quarter, we've completed 2 strategic acquisitions, which have really sort of built out our operational capability. And that's really the main thing that we've been looking to do. You know, the early stages of our business, we were a 4PL logistics provider, and we relied on other parties to complete our deliveries. And obviously, the last 2 years have been very challenging for the supply chain. There's been a lot of congestion and network delays, and obviously that affected the service levels that we could provide to our customers. So we acquired a 3PL logistics business last year, and we've managed to integrate that into the platform. That business unit is now profitable and will provide positive contributions to the business over the coming years. But it's been allowed us to obviously offer a guaranteed service level to our customers. And it's one of the key reasons why we're now able to attract the enterprise customers. Obviously, they've driven top line growth as well, which has been nice. You know, we are very much, you know, we're only just over 2 years old. We're very much a startup business, but you know, we're in a position now where we're generating a run rate of well over $20 million in fulfillment revenue, and on track to do over $20 million in GMV as well. The Parton business flowed through the results. Sorry, let me start again. This last quarter was the first time that we saw a full contribution from Parton business into our numbers, and so obviously it is one of the key reasons why there's a step change in our revenue numbers. But the organic growth across the business has also continued to be fantastic, despite the challenging conditions with the stop-start of the hospitality industry related to COVID. We also acquired Caddy, as I mentioned before, and Caddy only provided 3 weeks of contribution into these numbers. So there'll be another step change in our next quarterly results that we'll see as we start to incorporate Caddy's full GMV and revenue. But on a pro forma basis, Caddy has continued to grow incredibly well. I'm very happy with that business. There's obviously material increase in, I guess, the supply base from the acquisitions of both Partons and Caddy. And I'll talk to this in a little bit more detail in a moment, but it really is helping us to accelerate the network effect that we get across our platform and marketplace. There's significant synergies across the integration of those businesses as well. And we expect to release some more details around that over the coming weeks. But obviously, bringing those businesses together and also closing down our own marketplace and replacing that with Caddy has allowed us to introduce some material cost savings into the business. There's also obviously significant initiatives in terms of growth and how to really sort of harness, I guess, the potential of both the platforms. And I'll talk to that in a little bit more detail in a moment. Other than that, we also had a bit of a free kick recently, where we were able to complete the purchase, sale and lease back of one of the depots that we operate, our National Distribution Centre. Obviously, there's been a significant rise in industrial property values over the last 12 months. We had an option to purchase a site under our lease, and so we took that option, exercised that option, and completed a sale concurrent and to that purchase, and it was able to through that transaction, we were able to release another $4.8 million back into the company. In terms of our key metrics, and I'll sort of skip through this and talk to it on the next couple of slides, but revenue was up 78% on the prior quarter, and obviously up a massive 736 on Q2 FY21. As I mentioned before, that only includes the Caddy revenue contribution for the last 3 weeks of December. Our GMV, which is, I guess, for those unfamiliar with the term, it's the merchandise sales, or basically the value of the alcohol sold on our platform. Because we don't take ownership of any of that inventory. We charge commission of it. We can't report it as revenue, but we report it as GMV, and obviously our fees flow through into the revenue stream. But that was up a massive 615% on the prior quarter. Obviously, we've only just recently launched that platform, and so it's only just starting to get traction. Again, that does not include Caddy's numbers, which alone was another 4.5 million of GMV. So there's going to be a significant step change again in the next quarterly as we incorporate that into our metrics. Standalone, obviously, we've had fantastic growth in GMV just in the Wine Depot business. Other metrics that we talk to is the fulfilment platform, and that's probably best measured by the volume of cases that we handle or we ship on behalf of our suppliers. And that was up again a massive 79% on the prior quarter. And we also saw an increase in the number of cases that we ship per order. Significant lift. I guess that's partly seasonal, but it's also, I guess, as we start to complete more wholesale or trade deliveries. In the past, a lot of our deliveries were to consumers, and consumers generally will purchase just shy of 2 cases on average, where obviously trade customers purchase a lot more. The number of suppliers also jumped a massive 74% as we onboarded the Caddy suppliers into our ecosystem as well. For those of you, I guess, that aren't familiar with the business, I mean, there's been a bunch of projects that we've been rolling out over the last 2 quarters. Obviously, launching our own marketplace, which will now be replaced by the Caddy marketplace. We launched the direct platform, it's the one I mentioned before, where we allow the suppliers we work with to syndicate their inventory into the direct-to-consumer marketplaces. And also the staff drinks program only just launched at the very end of last year. Our platform, Connect, that I mentioned before, and you've seen in I guess our technology stack, we're about to launch the 2nd generation of that product, and it includes a bunch of new functionality, allowing us to start to monetize that product. So it'll sort of switch to being able to have a freemium and then also premium offer, where if you want to access that additional functionality, you need to subscribe. Obviously, the partner business we acquired last year, completed that acquisition, and that's been going incredibly well. We've invested over $1 million of capital back into that business to release a range of synergies operationally. Excuse me, and you'll see those start to flow through into our next quarter results. We also opened up our own dedicated site in South Australia, in Adelaide, and the collect service, which I touched on before, where we actually go out to venues, where we have been intending to expand that into New South Wales and Victoria and Western Australia, but obviously the COVID restrictions have made it very difficult for us to get in and do that. But we've now got that underway. We've actually launched in both Victoria and New South Wales just in the last couple of weeks. And we're also opening up the addressable market of that model by offering those services not just to wineries and distilleries, but also retailers that purchase through our marketplace. Operating cash flow, I've sort of included this slide because we had a few shareholders were alarmed after our last quarterly was released. And it was primarily because as I mentioned before, the GMV isn't something that we can report in our revenue, but it certainly flows through into our cash flows. And so we not only receipting, I guess, the invoices for our services now, but we are, and our trading commissions, but we're also receipting the payments from the trade buyers on behalf of our suppliers. And then we're also obviously remitting the proceeds of those sales to our suppliers as well. So obviously both cash inflows and outflows have been affected by that GMV. It hasn't been an increase in costs across the business. And as I mentioned before, there's significant initiatives at foot to reduce the operating costs of the business as part of that post-merger integration of those two new businesses. Cash runway, we reported 8.4 million cash balance at the end of December. That's been since topped up by the proceeds of the sale of our national distribution centre. We believe we have sufficient cash to get us through into calendar year 23, and the board and management are determined to make sure that's the case. Cost base, obviously last year we went through actually 3 acquisitions in total, but 2 in the last 2 quarters, and there's been significant non-recurring costs that have impacted the business that have been just expensed through. And there was also the launch of our own marketplace where we obviously there was a bunch of launch marketing that won't be recurring as well. I guess most of the cost-based, well, a significant chunk too is obviously investment activities to drive growth. You know, as I touched on before, we'll start to see a lot of those the efficiencies and synergies start to flow through in the next quarter's results. Some of the strategic initiatives underway, obviously, you know, we've had a period of significant expansion through acquisitions. And so we're really sort of spending this second half just consolidating the business and taking advantages of the synergies from those acquisitions. Leading that is what we call Project One, where we're really sort of pulling everything back to one vision, one brand, and one platform, one marketplace, one website. And there'll be more details announced around that project in the next quarterly. One of the things with any marketplace, and for those of you who've invested in technology marketplaces in the past, you understand that it becomes a bit of a snowball, and there's this thing called the network effect, where the more suppliers you bring into your ecosystem, it attracts more buyers, and then the more buyers that you have, you attract more suppliers. And through these acquisitions, we've been able to obviously get some material step changes in our supplier metrics, and it's obviously increased our product range significantly. And it's allowed us also to increase the amount of buyers. Where the marketplace, you know, we're currently growing at well over 100 new buyers a month. And it's really both, and this is something we're seeing in the fulfillment part of the platform as well, is that we really feel that we're at that point where we're starting to get an inflection as we go from being, I guess, into that past that tipping point of those on the leading edge into the mainstream. And we're certainly seeing an acceleration in our growth across those metrics. One of the other areas where there's significant opportunity in the business is cross-selling customers. Now, because of the acquisitions, we have pools of customers that are only using one part of our platform, be it fulfillment or the marketplace. And we are spending a significant amount of resources going into trying to grow the overlap between those customer pools, where we can increase our yield per customer significantly, but also creates a much stickier relationship with those customers, and makes it very difficult for them to move to a competitor if we're servicing at those 2 levels, creating an even bigger competitive moat. I guess the other area where we're really taking advantage of is that by taking control of our own fleet, we've been able to to really provide some best-in-class service levels. We've got a DIFOT that is one of the best in the industry, or it's a metric used to deliver the performance of your fulfillment platform. And we're certainly using that to start to attract those enterprise customers who realize that fulfillment experience is where they've often been let down. And so that's really allowing us to start to scale the business as well. Obviously, as a lot of these new suppliers coming on, they're certainly taking advantage of not just that fulfillment or superior fulfillment, but also access to the marketplace. In terms of the management team and board of directors, there's obviously some more details here. I won't go through it all right now, but Paul is one of the founders of Ironbridge Capital. That's a business that has at times had well over 2 billion of assets under management. He's obviously come from a investment banking background, so really brings a wealth of experience in terms of M&A and just private sort of equity experience. James, you probably have come across. He sits on a number of technology company boards in Australia. He's been heavily involved in bringing a lot of technology companies to market. I believe he's been involved in 7 IPOs in Australia alone and 1 on the London Stock Exchange. And I guess James' experiences really comes down to helping technology scale, not just in Australia, but also internationally. Myself, I've been kicking around the wine industry now for the best part of 3 decades. As I mentioned before, I've had a number of startups which I've successfully exited from. And those businesses have all typically involved technology in some shape or form, either to disrupt a potential sector or to differentiate our proposition. Mike Abbott has recently joined the board. He joined the management team as part of the Caddy acquisition. Mike had a background in investment banking and then got the entrepreneurial itch and was the second employee for Uber in Australia. And as the COO was able to obviously take or build that business into the brand we all know now and probably use on a almost daily basis. He was instrumental in growing both their car business as well as the Uber Eats. Across the rest of the team, we've got incredibly deep domain experience.
Yep. Sorry, can I just jump in there? We're just running slightly over time.
Okay,
so could we just go to the contact us slide quickly? I think, yeah, we've ran out of time for questions. I know our next presenter is on a tight schedule because they've got another engagement at 10. So in the absence of questions, I think if you can just maybe email Dean at the email address there, and I'm sure he'll be happy to take questions offline.
Yeah, apologies about the going over there, Mark. I appreciate the opportunity. Thank you very much.
Okay, no problem. And if you could please just stop sharing your screen, Dean. And I know Mark from Spacetalk is waiting in the wings. And yeah, I can see the cover slide now, Mark and Dimitri, so you guys are ready to go.
Good morning, everybody. My name is Mark Fortunatow. I'm the CEO and founder of Spacetalk. Spacetalk is a wearables company or connected wearables company. We design, make, and sell connected wearables devices. Connected meaning that they're all-in-one smartphone, watches, and GPS devices. We address 2 markets for kids and the other one for seniors. For the kids market, our target age group is between the ages of 5 and 12. And it's a new category that's rapidly emerging because with Spacetalk, kids and parents can now benefit and enjoy all the benefits of mobile technology without the dangers. So what sets us apart is that we own the entire end-to-end ecosystem. So we own the designs of the watches, both the industrial design, the engineering design, the firmware, the apps, the servers, and so on and so forth. We've been in the market since 2017, and we've sold all over the world. Next slide, please. So we have two kids devices in the market, our original Spacetalk Kids, which is the teal colored watch there, and the other one is Adventurer. We've been in the market, as I mentioned, since 2017. And then we have a device for seniors as well, which is called Spacetalk Life. Connecting all the devices together and also controlling the devices is our app called the Spacetalk app. And for parents, it allows parents to configure and control how their child uses the device. So in other words, it means that they can they can select which contacts or which people the child can make and receive phone calls from, text messages, stay in communication with, and we have a chat functionality, a group chat functionality for extended family members. But most importantly, the devices for kids do not have access to the open internet, so there's no access to social media, TikTok, YouTube, and addictive, dangerous apps for adults. We actually commenced the business over 21 years ago, and that business was called NGM Wireless. And in fact, that business is still going, and some of you, I think, may have come across us in the past. So 21 years ago, we started the company and we focused on providing communication systems for schools. So schools could rapidly notify parents if their child hadn't arrived to school, if there's an emergency. That business is still going. It's doing well. It generates about $2.2 million in revenue with a high margin. Next slide, please. So we've released now 2 devices in the market, and we're working on our third. We're code-naming it Adventurer 2 for the time being. It'll be released later this calendar year. And that really will build on all of the learnings and experiences and new feature requests and needs of our customers moving forward. We do a lot of work in our app to continuously improve it and enhance it. And we'll be introducing premium paid services in the future. Currently, we charge for our app. We charge $5.99 per month in Australia and New Zealand. We bundle it with operator services in the UK and the USA. But we're looking to extend and capture more value with our app by introducing advanced premium services later this year. We distribute through mass market retailers. So in Australia, that means companies like JB Hi-Fi, Harvey Norman, Officeworks, and the like, and also operators. So in Australia, we have Telstra and Vodafone, and we can distribute across Australia, New Zealand, Europe. We're in the UK. We're with O2, the UK's largest operator there, and a number of retailers. And in the Nordics, we're the largest mass market retailers there, Elkjøp and Gigante, and a number of mobile operators there as well. So we also operate our own e-commerce websites for the direct-to-consumer sales. With our seniors device, we sell and developing our channels through the aged care service providers. Whilst the technology there is very similar, the actual path to market is very different. So that's a sample there. So in terms of our results, where we landed to December 2021, our group revenues grew 50%. We've been tracking between 45 to 50% for the last 3 years compound growth. We're in a very large market, which I'll come back to in a moment. Our wearables business, so as mentioned before, we have 2 businesses, the original schools business, communication business, and wearables. The wearables business achieved 11.4 million in revenues, which is up 58% period on period, with a good gross profit margin of 57%, 6.9 million. And we finished the calendar year with 9.7 million in the bank. Our school revenue is steady. Our school business is steady. It tracks at about 2.2 million in revenues per year with a very, very high gross profit margin of about 94, 95%. As you can see, the panel on the left there, our revenue contribution per quarter, you can see quarter on quarter how we're tracking there and where we're likely to land for the end of this financial year. Our device revenue comparison for 3 years ago is growing. It grew 57% last year. And our app recurring revenue, so as I mentioned before, we have an app that's associated with our devices in Australia and New Zealand that we charge for. That's tracking now at over $3 million recurring revenue per year, and it grew at 75% year on year. So you can see on the left there, as we open more and more stores, we're in about 2,000 stores. That's across Australia, New Zealand, UK, and the Nordics. We're in a very aggressive expansion strategy at the moment in terms of increasing our distribution. We just opened in the United States in late November of last year. We're just speeding up all of our distribution there at the moment. We're currently online with Best Buys and Amazon and our own website. We will be expanding into bricks and mortar stores this calendar year across America. The interest level is high, and we look forward to growing that business and reporting back with significant sales results throughout the course of this year. So you can see in the center panel there, if you go back, sorry, you can see on the center panel there, we have where the revenue is coming from. At the moment, it's still primarily from Australia and New Zealand, but we're very pleased to see a good growth coming through in Europe, and we're just starting out in North America. And the rightmost panel, you could see how our recurring revenue is growing. So how we're tracking this calendar, or this quarter, I should say. So what we've seen, we'll be doing a very large promotion in March, commencing next week across Australia and New Zealand. And we look forward to seeing the results come through from that. Our Europe sales are growing. We're seeing that as our main source of growth at the moment, and we're very, very pleased with that. And we're tracking so far as at the end of January, we're up 15% on last year. And we expect that to improve as we move forward and through the quarter. And North America, we've just started there. The actual sales are still modest, but there's a lot going in the background to expand our distribution and get the sell-through happening. So we're very, very excited about opportunities in North America. During the last quarter, we made a number of senior appointments. We appointed 3 executives: Jim Quinn, who came from Apple and Fitbit in Kinza as Chief Operating Officer; Mark Maloney as Global Sales Director. He came from JB Hi-Fi. He ran their wearables division, and he's a veteran of the wearables sector, retailing wearables in Australia. Arguably one of the most experienced and successful people in Australia and New Zealand in the retailing of wearables. And Martin Derbyshire as Chief Design Officer. He was the founder of Tangerine. Tangerine is a design firm based out of London that we have used for several years now to improve and enhance the design and aesthetics of our watches. The firm Tangerine is famous as being hired by Steve Jobs from Apple to design the iPhone and iPad. We're very pleased or thrilled in fact that Martin is leaving his own firm to come work with Spacetalk to improve our designs and the customer experience that we provide. And we've just enhanced our board with Mr. Saurabh Jain, who's joined the company as non-executive director. He was the former CEO of Urbanized, and we're currently searching for an independent non-executive chair. We've got Russell Reynolds on the job, and we look forward to closing that out in the coming months. So the scorecard we keep ourselves accountable for is, first of all, the growing, in terms of the background. So wearables is one of the fastest growing sectors in consumer electronics. And within that sector, connected kids wearables is one of the most fastest. Now, the industry or the category is still in its infancy. The addressable market size, which is kids between the ages of 5 and 11 in the Western world, is about 70 million kids. And the collective sales of the entire industry at the moment are about 500,000 units. So you can see the growth opportunity is significant moving ahead, and arguably we're the leading brand, but we're certainly one of the most leading brands in the world. We've expanded our distribution last quarter into the USA, Canada, Norway, Sweden, Denmark, and Finland. And you'll see further distribution expansion moving forward. Our revenue growth, any way you look at it, is between 50 and 60% using and it's compounded now for the last 3 years. We've enhanced our quality, the quality of our management and depth of our management with 4 senior hires last quarter. We're well positioned for growth. We have a very unique offering in the market. We're the only company that has its, first of all, we're the leading brand, and we're the only company that has owns its own end-to-end solution. All of our competitors buy an off-the-shelf product from a Chinese supplier, rebranded as their own brand, and it's distributed. We're the only company that designs and has its own devices, and most importantly, the back-end ecosystem, which is arguably the most valuable part of the entire solution. So moving forward, we're working on the next generation in wearable for kids now to be released later this year. We'll be delivering enhanced and premium app services to improve our revenue and margins and profitability and capture more value from what we deliver from our products and services. And we have a tremendous opportunity ahead in front of us. So we're very excited, and we're excited to start booking simply start booking the revenue from the United States. Thank you very much. Are there any questions?
Thanks, Mark. We actually have one that was emailed in ahead of time for somebody who couldn't join us, but is going to watch it back on the YouTube channel. The question is there any additional geographies planned for 2022, or is the plan to expand sales in the current geographies that you've got?
Well, we'll be in addition to expanding in the United States and Canada, we'll be expanding across Europe as well. We've translated our products into 5 languages already, and we're working on another 3 as we speak. So it'll be further expansion across Europe in addition to where we currently are in the countries that we currently are.
Okay, and then one from the audience. Have you explored selling the schools business to further fund the wearables business? It seems attractive, particularly versus raising capital.
Yes, it's a very good question. Look, we're looking at all the possibilities for that business. We're actively looking at it, and we'll report back, obviously, to the market with what we decide which way we go with that business moving forward.
Okay, and then one from me. Is there any scope to increase the monthly charge on the app? Move it from $5.99 a month to $6.99 a month, or are you more focused on the paid premium services to kind of drive up that average revenue per user?
Great question. So look, we're clearly delivering a lot of value to customers that we're not always capturing. So we're very focused on it at the moment through the addition, through using new business models to capture more value ourselves from what we're currently doing, and through the introduction of new in-app purchase experiences and premium services. We'll probably end up with a number of different models there because there are different models that suit different types of customers. But it's an area that we certainly shows has tremendous potential for the company, and there is some really exciting things that will be coming out later this year.
And then I don't know if you disclose it, but have you got a split in the revenue between the kids wearables and the seniors sales?
We don't have a specific split, but the seniors wearables business is emerging. It's an area that we're working with a number of operators globally and Australia. It's a market that's coming, but it's still in its infancy. The distribution channels for seniors is very, very different to kids. I mean, seniors do not generally go to Harvey Norman or JB Hi-Fi or walk into a Telstra store to buy themselves a safety wearable. They're generally introduced to this type of device through an occupational therapist or their aged care service provider. Our device, interestingly enough, is fully funded by NDIS and by the Commonwealth Home Care package and the state packages as well, fully funded. So look, it's an area that it's growing. It will become a big market, but the market and all the pieces to that market are being put in place at the moment.
And is there potential, do you think, for government funding or insurance company funding in the US or Europe in a similar vein on the senior side? Absolutely.
It's a very unique device. There's nothing like it in the markets that we're currently at. It's what sets us apart is that it's a very simple yet powerful device to use. And because we own all of our ecosystem and data, we can actually connect and share that data, of course, with the user's permission, with the aged care service providers to develop solutions where these providers can actually anticipate and predict oncoming problems with the seniors, which in turn generates a lot of efficiencies and cost savings for these people. So yeah, absolutely. There's a great deal of potential and opportunity for government funding.
Okay, in those markets. Another one from the audience, Mark. Can you provide an update on talks with Best Buy? It says they originally pulled back from online distribution late last year as they wanted to do in-store as well. So just a question on how the renegotiation or maybe strategy rethink on the launch with Best Buy in the US.
Well, the conversations are continuing, and we'll definitely be in stores across America later this year. With Best Buy, we just ran out of time, or they ran out of time because we were running up to Christmas. But our sales on Best Buys are growing. Our presence on Best Buy, online sales on Best Buy are growing. Our presence is growing. If you do a search now, we're appearing on page 1 now in a number of slots, which is good. Last time I looked, we had 4 positions on page 1, which is very good. So there is a significant market out there for the connected kids wearables, but the market itself is in its early stages. So the awareness is growing, yeah, so getting back to your question, that you'll see further progress with Best Buys later this year.
Okay, great. And just on the geographies, I notice Asia, or let's rephrase that, developed Asia, you know, the South Koreas, Malaysias, Singapores, Thailands of the world is not on the map there. Is that by choice because you'd rather focus on Europe, US, or is there a specific, you know, reason that you're not entering those markets? You know, language, translation, time, costs.
Well, if we can win the US and Europe, we'll be in a good position to win in Asia as well. Reality is we're a small company and we can't tackle everything at once. So we need to go where the biggest return, the biggest opportunities are for us. You know, we're very bullish on our opportunity in America. Once that gets up and running and we see meaningful results coming through, that'll naturally put us in the top position to be a partner of choice with telcos and mass market retailers in Asia. One thing everyone needs to remember really is that this is a category that's growing rapidly and it's emerging. and certainly all mobile operators and some retailers. But the operators, they share data within the industry, and they can see the take-up of these devices in various parts of the globe. So it's very unlikely that there'll be any mobile operators or mass market retailers that will not be in this category. Now, we are the #1 brand globally. So if they're going to go into this category, they'll be wanting to come with us. But given the resources that we're working within, it's very important that we do well in the US and UK and in Europe, and that will naturally then put us in an even stronger position for Asia.
Great. And in turn, I know you were talking about Adventure 2. Should we expect, a kind of a product refresh like Apple does, every September, a new version of the iPhone comes out? Or, are these kind of, I can buy one for my kid when they turn 6 or 7, and actually I can get the full 5 years out of it? I'm just trying to get a sense of, how often would parents need to upgrade the hardware, if that makes sense?
Well, the lifespan of a wearable is generally 2 to 3 years. We've been coming out with a new device now. We've come out with a new device so far every 2 years, and that's counting the one that's coming out later this year. So we'll be continuously coming out with new devices and upgrades. Upgrading the device is very important, especially the aesthetics of the device. So it's very important for us to get it smaller, thinner, narrower, that type of thing, getting improved the hardware functionality and the components of the watch. However, because we own all of our software, we're continuously releasing new features and upgrades over the year to the watches and to the apps. So in October, we released what's called the Level Up campaign, which came out with 6 or 7 new features. We've got some new exciting features coming out in a few months' time. So we're continuously enhancing and improving the user experience throughout the cycle in between new device launches. And you'll see as we launch a new device, the existing devices will probably start dropping down in price points and we'll retire out some of the older devices in due course too.
And then a final question, pushback from schools. I know a lot of schools, especially at that primary age, ban kind of mobile phones of any description, in class or on school premises. Yours, I guess, is kind of one step below that, but what is kind of schools' feedback been, or parents saying, my school won't allow a Spacetalk device? Has there been any kind of chatter in the kind of principal community that you've heard, via the school's business or just in the markets generally?
Yes, great question. Well, we have very good relationships with most schools in the country and all education departments. When we launched in 2017, pretty soon afterwards, various departments, education departments around the country started banning wearables for young kids. And that was until we launched an awareness campaign into schools and education departments to explain the differences between our device and other devices. So first of all, we have this feature called school mode. It's like flight mode, but it's called school mode. So, and then your watch goes into school mode when the child's at school. So what that means, the device becomes totally locked down. All phone calls, text messages, chat, everything is switched off, and the watch is nothing more than a wristwatch during school time. So it's not a distraction. Secondly, schools and teachers in particular quickly realized that with Spacetalk, parents can communicate to their kids during school time if needed. So if they've forgotten their lunch money, or there's a change in pickup arrangements for after school, they need to go to after school care and the rest of it, the parents can sort that out with the child directly, which eliminates the need for the school and teachers and school administrators to be runners of messages between the school office in the classroom. So once the schools work that out, a lot of schools are actually supporting Spacetalk now, and they actually, some of them even promoting it through their bookshops, and certainly in fundraising campaigns and sponsorships as well. So the whole thing is turned on its head, and where schools are very open to it, in fact, encouraging and supporting parents to take up the device, because it's not a distraction during school time. And of all the features, the safety features, so that the child cannot access social media, no open internet, no YouTube, and also the child cannot send or receive text messages or phone calls from unknown people. So there's no chance that the child will be bullied from unknown people by wearing a Spacetalk, and there's no chance that they will be a bully because they can't text anyone or call anyone, and that's not on the pre-approved contact list that the parents set up. So it's actually now becoming a supported device in schools.
Okay, great. Mark, we'll leave it there. We're right on time, and I do appreciate you've got another meeting to get to, so we'll leave it there. Thank you very much for joining us this morning. And yeah, Dimitri has stopped sharing the presentation. Simon, who is our next presenter, if you want to start sharing your slide deck, I'll let you know when I can see it coming through. And yeah, if you can just go to slide share or full screen mode. Yeah, I think if you just, yeah, there we go. Perfect. Your audio is just not coming through, Simon.
All right, can you hear me now, Mark?
Yeah, we can hear you now. Perfect, thank you.
Fantastic. No problem.
Yeah, good to go.
Thanks very much. And thanks for having me on Coffee Microcaps. Excited to be here, really excited to share the journey that we are on at GeneType. And I'm really excited to actually share the position where we are today as we're really entering that phase of revenue generation. So over the next sort of 15 to 20 minutes, I'm going to share with a top line journey of where we're up to. And I'll also make note that only a matter of probably, 10 minutes ago, we announced our half-year results on the ASX. So any more specific details around the company, you can easily download that from the GTG portal on the ASX. Just take a moment just to acknowledge the forward-looking statements here on the presentation. So just outlines the presentation itself. Over the next 15 to 20 minutes, I'm really going to take you through these 6 key focus areas: our vision and our values as an organization, our markets and our global presence, our market opportunity, which is a really important piece, our channels, our divisions, and our portfolio and innovation, and specifically finish up with what are we focusing on over the next 6 and 12 months. The GeneType vision is simple. We want to unlock personalized preventative healthcare. We want to transform the conversation, transition from a one-size-fits-all model to a personalized predictive health assessment where every person has the information that they need to manage their health in accordance with their own individual risk. We want to empower physicians to improve health outcomes for people around the world, tracking disease to its source and enable that new era of personalized predictive medicine. Our technology is patented. The risk assessment tests are patented and protected for a range of serious conditions. And as recently as of Monday, we just had approval in the US and in Australia for a suite of tests which cover 6 diseases that I'm going to talk about in quite a bit of detail towards the back end of the slides. The GeneType tests integrate individuals' familial, clinical, and genetic information to create truly actionable outcome and clinical insights for physicians, which is really important. It integrates all of those aspects, not just a simple genetic test. It combines genetic and clinical risk models with cutting-edge research as well, and leading that personalized healthcare revolution conversation between patients and physicians. And as you can see down there below, there are a number of different patents that are granted across the world and some that are still pending. And even as recently as yesterday, we were granted a new patent for the COVID risk test that we launched last year, which is just a fantastic achievement from the team. And that was announced on the ASX also this morning. Our global overview. We have 54 employees around the world. We have presence in 40 countries, and we have 26 patents. 9 of those are pending. We have 14 test categories now with the acquisition of our EasyDNA business, and we have 51 tests on offer around the world for direct-to-consumer and for physicians to use. And we have relationships with 12 partner laboratories and 1 owned laboratory here in Melbourne, Victoria, Australia, for depending on where everybody is in the audience, that we actually own, that is not only CLIA certified in the United States, but NATA certified here in Australia. So it's a fantastic achievement for the team. So we can do samples from all around the world here in our laboratory in Melbourne. Our key geographies and collaborators in the United States, we launched last year the breast cancer and colorectal cancer through our CLIA certified laboratory and here in Australia. We also got approval this week for a multi-test, which covers 6 additional tests with 3 more to come over the course of the coming months. We have a presence with EasyDNA across Europe and multiple countries across Europe and the UK, and we're commencing our CE certification, enabling the European launch of the multi-test that was just approved in Australia and the US this week. We have EasyDNA coverage across many of the Southeast Asian countries as well, but there is still more opportunities for us to tap into new markets, and I'll talk about the growth strategy of the EasyDNA acquisition just in a moment. And we're just commencing the scope and the prioritise of the market entry strategy for GeneType, and in the final stages of validation of some of the ethnicities across the Southeast Asian markets for some of our other tests, which will give us even broader scope and broader reach for innovation and execution across the coming year. In Australia, our certification is by NATA, our regulator here. A GeneType multi-test, which has the 6 tests, has been approved. It covers breast cancer, ovarian cancer, prostate, colorectal cancer, coronary artery disease, and a metabolic disease, type 2 diabetes. Our Melbourne laboratory, as I mentioned, is NATA and CLIA certified, so we can take tests from around the world and do them here in our laboratory here in Melbourne, which we're very, very proud of. Our brand values are built up on 4 key pillars. We're unequaled experience. Our scientific team leverage their extensive research and track record in breast cancer and colorectal to actually build a next generation of medical grade tests and conditions for cancers and other diseases, serious diseases. Integrated technology, this is where our technology is truly unique. It integrates the genomic and clinical risk factors to make the most comprehensive risk assessments for serious diseases in the world. This is the foundation of our GeneType brand. The relentless pursuit of innovation, we're accelerating the transition to a personalized preventative healthcare model, converting genetic data into truly actionable outcomes for physicians and their patients. That's where the true magic needs to happen. If the physician can't action this for a patient to create really good actionable outcomes to prevent serious disease risk into the future, that's what we need to be aiming for. Setting those new standards in clinical, safety, and ethical standards. So the GeneType PRS platform, it's a proprietary risk stratification platform that actually is developed over the past 10 years, integrating clinical and genetic risks, delivering actionable outcomes for physicians. That's the core for that on those 4 pillars. Our focus as an organisation, to bring it down to a little bit more granularity, is to commercialise the GeneType suite of multi-tests, is to grow the EasyDNA business with new tests, new channels and new markets. Focus heavily on the clinical validity and utility of the GeneType tests. And we have a very, very experienced scientific and medical advisory board that actually helps us with that clinical utility with studies and co-contributors to articles to make sure that peer-to-peer transition of tests in clinic is actually shared across the world. Bolstering our commercial bias to our OPEX. This is a real pivot for us in the last 12 months, where we've been very much an R&D innovation company. Now it means we need to actually turn this into a really strong commercial proposition. And you'll see in a moment, we are in our first half of delivering revenues for the future for the organisation, which we're very proud of too. Talent and capability acquisition, and our innovation for a future pipeline, which is very bright, through our entity Gene Ventures. What I wanted to do here was to just share with you the market opportunity and the market size. I've picked 2 key segments to share with you today, and they're a little bit more when it comes to the total genomics market. But the predictive genomics market, which is the GeneType brand, has an opportunity of $1.3 billion between now and 2025, a compound growth rate of about 16.3%. And in the direct-to-consumer space, where our business of our EasyDNA platform across 40 countries plays, has an opportunity to grow 1.4 billion and 18% CAGR over the next few years to 2025. So the opportunity for us to continue to grow and seize market opportunities and open up those channels to market for growth and for revenue is very, very large across the world. And we're very excited to be focused heavily on these two specific channels. Our pathways to market are really tightly defined and distinct. We've got the direct-to-consumer testing platform where there is no medical supervision required. This driver for us is leveraging the EasyDNA brand and the platform, and it provides the foundation of growth in 40 countries. As I mentioned, we've got agreements with 12 laboratories across North America, Asia Pacific, and Europe, and we sell a number of different test categories across the EasyDNA umbrella. We have on the other side the medical business to business, which is a physician-generated test request, where we're looking at the serious disease tests for the reimbursable space. Now, we're in the middle of doing a health economic model with a company in Boston called Alva 10 to really curate a model for the payers and the insurers, the employer groups, primary care physicians, to get our tests reimbursable into the future up there. That's what that plays there, but that has to be a healthcare and a physician-generated test. In the middle, there are a number of curious, worried well around the world that actually want to know what their risk of serious disease is. And we've built a consumer-initiated test platform. The difference between this and a direct-to-consumer platform is that there is medical supervision required. So those test results need to go back to that customer's individual, their nominated physician, to be able to get the results, because we can't deliver a potentially high-risk result to a patient without having the appropriate medical supervision to be able to give that information. So we have a number of partners around the world. We launched it in the US and in Australia in 2020 with 2 tests, and the multi-test will be launched there. After we've launched it to physicians this week, we'll be launching that to the consumers in the course of the next month. Our pathways to market, and just to show you how we're executing a multi-brand strategy across those 3 different channels there, the direct-to-consumer channel in EasyDNA focuses heavily on ancestry, paternity, health and well-being, pharmacogenetics, animal testing, drug testing, relationship testing, and even to the point of rapid antigen tests here in the Australian market. The consumer-initiated space looks at taking some of the more medical tests out of the EasyDNA pipeline, bringing it into the GeneType pipeline, and segmenting that market so we get the messaging nice and clear as you start to get more serious and serious disease, health and well-being and nutrition, oncology, cardiovascular, metabolic. This is all tests that appear on our multi-test, and the more serious drug interactions of pharmacogenomics, which is slightly different. And then that healthcare professional requested test in that B2B channel here, oncology, cardiovascular, prenatal, NIPT, clinical and molecular, metabolic, and mental health with Talias model that we have licensed from overseas. So there's the way we break out our brand across the distinct channels, across the markets around the world, to make it really nice and clear for people to understand what we do. There's a lot of work we're doing at the moment with regards to EasyDNA and that brand, and I'll show you a little bit about that growth agenda for that brand in a moment. Our innovation and some information about some of the products. I mentioned earlier that we hit a wonderful milestone this week with our multi-test. This is the GeneType suite of tests. We were approved this week, not only simultaneously in the US and in Australia, for the phase 1 launch of our multi-test, which includes breast cancer, colorectal, prostate cancer, ovarian cancer, coronary artery disease, and type 2 diabetes. This first phase of the launch will cover more than 50% of mortalities and morbidities. When we add the other 3 that are planned in the later part of this year of atrial fibrillation, melanoma, and pancreatic cancer, this test alone will cover up to 70% of mortalities and morbidities annually. And it's a really great opportunity for people to have a conversation with their doctors, with their physicians, to order this test and understand your individual risk and start to identify, if you are high risk at a particular serious disease, that you can implement some actionable outcomes to minimize that risk or provide early detection. Early detection is key. is key for the long-term health of an individual and patient, but that dialogue with the physician needs to start. This picture of the kit there is our new kit. We've made a decision to go to one kit. We've paid a little bit extra for this kit, but it is EU, TGA, and FDA approved all around the world. This test, this collection device, this saliva collection device here can actually cater for all of our saliva genetic capture tests and can be done in our laboratory. So we've got one kit, one collection kit that will cover off all of those diseases, which manages our overall inventory, our supply chain. And it means that we don't have to have different kits for different diseases in different countries and different markets. So there's an amazing efficiency that the team have been able to build into this one kit. And this has been brought out to us, and the product sponsor in the United States is DNA Genotek. Also wanted to take a moment just to talk about our COVID risk test. COVID's been in the news obviously for a long time now. And this team last year launched a risk test for the COVID-19 disease. This is not whether you have it or whether you don't have it. This is your risk of getting serious disease, and it's launched in the United States in partnership with One Health, IBX, and VitaGene. Yesterday, and as announced today, we were granted a patent for the COVID risk test, which again combines genetic and clinical risk factors of an individual for getting a serious case of the disease. This is really important, especially for those people who are in non-traditional high-risk categories, or potentially people who are vaccine hesitant, and a number of those people that want to understand what is my individual risk. We know through some of the work that we've been doing with our health economic modeling company that an unvaccinated worker that goes into a workspace in the United States that is hospitalized with COVID-19 is costing that employer $56,000. So the investment in $175 on a COVID risk test is actually quite a very good investment in that person's health. That employer can then make decisions about whether or not that employee should be minimizing their risk and maybe making decisions to say work from home and the like. So we did a campaign in January where we had some heap of consumers driving towards this. So this link there goes to our website, Genotype in America. It's geo-fenced, so if you're an Australian IP address, you probably won't see it, but it will be seen in the US. It goes through to VitaGene, they're partners with us. They do all the kit management and send it to our partner laboratory in the US, which is IBX with their testing. Some of the divisions and the operations, we've got oncology, cardiovascular disease, COVID-19, serious disease risk, metabolic diseases, and our lifestyle channel. The three in the lighter green, the teal color there, are where our innovation is pushing forward to beyond the multi-test for ourselves. Pharmacogenomics and mental health, germline testing, reimbursable for in Australia, which is BRCA and Lynch syndrome, which is the hereditary elements of some of these diseases for breast cancer and colorectal cancer. So partnering the hereditary element of BRCA and Lynch syndrome with our PRS of colorectal and with our breast cancer test, we have 100% coverage of the risk factors, known risk factors for both of those diseases. So it's a comprehensive risk assessment test. And we're also looking at carrier testing, NIP testing, and reproductive carrier screening. A Genotype portfolio, this is a bit of a chart on what's happening over the course of the next year. We launched breast cancer and colorectal cancer in 2020. We launched our COVID risk test in 2021. We're launching with healthcare professionals now a multi-test for the first 6 diseases, the phase 1 launch and the market release, which covers up to 50% of all morbidities. And then the next phase, which is the next 3 tests, will cover up 70% in total, and that will be available on commercial or regulatory approval. So physicians can start to order this test now in Australia. So if you're interested in this particular test, talk to your doctor, get online, and we'll make sure that we'll talk them through getting a kit and interacting with everybody. Here's a couple of charts, and I'll preface this chart by saying that I am not a scientist, I'm not a medical professional, I am of a commercial background. So if there is anybody on the call that actually wants to know more about the science that sits behind the amazing technology from our team, I would be more than happy to introduce you to our Chief Medical Officer or our Chief Scientist to be able to give you greater insights and clarity and depth of knowledge and understanding behind these charts. But this really depicts that we can identify potentially high-risk patients 10 to 15 years earlier than the current screening protocols that exist, and they could exceed that earlier. We could identify this, people with, say, for colorectal cancer, from screening them from 35, rather than waiting for, say, the fecal test, which comes out at the age of 50, we could identify potentially high-risk patients, and they could be taking precautionary action earlier in their life. I just wanted to wrap up with a couple of key operating insights after telling the story and sharing the vision about the business. As I mentioned earlier, this is a really exciting time for us. We're at the first stages of generating revenue. We've hit $2.05 million. This will be published on the ASX today. I think it's already up there now. Before I started, this is to the half ending December 31, 2021. Cash balance in the bank of $13.5 million. So we have a good runway to execute our plan that we have going forward. Gross margin for the revenue was $850,000, so about 41.7%. As I mentioned before, some of the strategic and operational highlights that we received the accreditation from NATA and CMS on the multi-test from 17th of February, announced that on Monday to the market. US patent gave us the patent for the COVID risk test, which was fantastic, and the acquisition and the integration of EasyDNA, which was in the back half of last year, for now a platform for us to grow our GTG-based products. In that quarter, we also relaunched the GeneType brand and the digital strategy, and you can see here from some of the brand performance metrics that we've got 115,000 brand impressions, up nearly 200%. Our clicks and socials are up nearly 186%. Our social media engagement is up nearly 200%, and our website visits and unique visits are up 64%. What's really interesting is some of the origins of some of the countries that some of these people are visiting our website from, and being able to track where that real interest is lying across the world, outside of just the Australian market and the US market, across Europe and even across India and into Southeast Asia. It's really fascinating to watch where these are coming from. Our growth strategy for EasyDNA is key. Revenue is key, as I mentioned in our focus areas. A brand refresh. The multi-brand portfolio, EasyDNA's brand refresh is a real key piece there. The logo is a little bit tired, a little bit dated. It still needs to fit with the family of brands that we've got here at GTG. The website refresh, new development. At the moment, we're sitting on a number of different websites, and the user experience needs to be improved, so we can then target messaging. We can make it more focused for each of those different countries. We then move into the lead gen part of it. We actually do a better job with Google ads, Facebook ads, and other content marketing, influencer execution, and then that'll lead to driving new sales channels, marketplaces like Amazon, targeted B2B consumers groups, and other new markets such as India, and pushing further up into Southeast Asia, for example. So that's our growth strategy. Very, very simple 4-part strategy for the EasyDNA brand. Just wanted to take you through a snapshot more broadly of the 2021 achievements that the team made. We signed a multi-year distribution agreement with IBX to license the COVID risk test. We expanded the COVID risk test towards the back end of the year with One Health and VitaGene, and we launched on the consumer-initiated platforms in the US and Australia. We acquired EasyDNA. We integrated the EasyDNA business. That settled in the end of August last year, so we're about 5 months into that business now. And it's a global platform for us to be able to take a GeneType multi-test to market and communicate that around the world. We continue to focus on R&D and collaborations and innovation. We are doing an African American breast cancer research collaboration with Professor Colditz at Washington State. We presented at the 2021 San Antonio Breast Cancer Symposium. We also attended the American Academy for Anti-Aging in Las Vegas, and we're also participating in the Nurses Health Study. The new pathway for the multi-test I've spoken about, we have a robust patent and portfolio of our clinical credibility, which is the patents that I talked about there. Our focus over the next 6 months is the clinical utility and clinical validity and publication strategy for our multi-test for healthcare professionals to really focus on embracing these tests. And again, I mentioned a solid cash balance of $13.5 million. Gives us a runway of about 22 months for us at the moment based on our current trajectory. In summary, I just wanted to wrap up by just saying these are the 6 key focus areas for us as an organisation. Commercialisation of the GeneType suite of tests is critical. EasyDNA growth, the new tests, the new channels, the new markets after the brand refresh. Demonstration of that clinical validity and the clinical utility of GeneType. The commercial bias of our OPEX. The acquisition of good talent and capability in all of the markets, and that innovation pipeline beyond the current tests that we've got. I just wanted to finish it there. I know that's very, very top line. I think I've taken about 23, 24 minutes. So I think I've left a little bit of time for some questions from the audience, and welcome those questions, but also welcome the opportunity if you wanted to have a deeper conversation with us about not only the science, the medical and everything behind that. Please feel free to reach out. Stephanie's on this email here, or obviously Mark through Coffee Microcaps. But I'll leave it there and I'll wrap it up. And thank you for allowing me to share our story. It's a really exciting opportunity for us.
Thanks, Simon. I actually had two questions that were emailed in ahead of time for somebody who couldn't join us this morning. So I'm just going to tackle those first quickly if I can. They referenced the GP margin that you, sorry, they don't reference. They wanted to know roughly what are the margins in each of the three pillars. So direct to consumer, the customer patient initiated one under medical supervision, and then the pure medical one. Can you give a sense, kind of broadly where the GP margins sit in the three of those?
Yeah, broadly speaking, the margins at the moment in the direct to consumer is sitting around about 50%, 51%. So it's a little bit higher there at the moment, but that's where the majority of all of our revenue is coming from at the moment. The revenue in the CIT and the business to business channels at the moment are low because the sales are low. So it's all about product mix. We are expecting gross profit improvements in that channel. At the moment, we're forecasting that we should be able to do some gross profit numbers of around that sort of 45, 50% in that B2B channel. And then what we need to do is overlay that reimbursable space. So once we're able to get reimbursement, that'll actually change the margin mix again as well. So there's some top line numbers. I can get some more specifics as we build up some more stability in the revenues in each of those channels. That will become a clearer picture, but there's some of the forecast margins that we're talking about at the moment.
And then their second question was, where are you envisaging the revenues in those three businesses, kind of a percentage split? Let's say if we look out, 3 years time from now, will the direct to consumer be the dominant one, or do you think it'll be the medical one and be the dominant one?
Yeah, I think in the short term, for sort of the 0 to 18 months, the highest value of contribution will come from direct to consumer, and then a little bit in consumer initiated testing as physicians become more and more au fait with the brand and the technology and integrating into their clinical workflow. Our vision is that risk assessment tests become a natural part of a clinician's care program, that next level of care programs for physicians and their patients. What we will then see is then an increase in that B2B channel, which there will probably in 3 years' time, if I was to sort of future pace it, we'll probably have about 40% of our revenues coming from direct to consumer, about 40% of it coming from B2B and physicians, and about 20% of it coming from that consumer initiated, that one that actually just proactively taking part of themselves. So I think that's the split over the course of the next 3 years. That'll start to evolve over the next 12 months, 24 months and 36 months. And it'll start more heavily in the direct to consumer and move towards the medical testing there.
And then one from me, I know the Microba IPO is coming up, which is kind of in the same space that you're in. Is there an opportunity to, do some white labeling deals with, people who've got these, gene type tests, or, looking for specific biomarkers, but, haven't got the 40 country distribution and the kind of regulatory experience of taking a product global, where they can, come to you guys and say, hey, look, we've got developed a test, would you be interested in, white labeling it under the Easy DNA thing, and, you just run it through your kind of distribution network that you've created?
I think that's amazing, a fantastic question. The answer is yes. So what I didn't touch on there, other than the targeted and distinct pathways to market and the channels to market, we have 3 different revenue streams. One's obviously the direct selling model. 2 is the license model, where we'll license a product in or out-license our technology. And 3, when we get to it, is the reimbursable space as we build into that over the course of the next 6 months and 12 months. Using the EasyDNA platform as a potential marketplace to be able to help other people create market reach and then be able to then create more access for more products and for that business to be able to help make some money along the way there is absolutely a model that we would explore with partners that have alignment to the audience, because the audience has to be relevant to them. But absolutely, that's a model that we would look about and have a conversation with people about. No problem at all.
And then a question around supply chain logistics for any kind of business operating globally these days. It's come up a lot as we've moved through results season, a lot of commentary around it. How have you found, trying to get ready for this big launch and initial sales, and, stocking up, I guess seems to be the theme at the minute, where people are overstocking in the kind of advance of what they predict, sales are going to be in 2022. Could you maybe just give a talk about what you're doing there and the kind of impact on working capital?
Yeah, I think two things. Supply chain was a really big one for us on thinking about how we're going to get market reach, which is why we chose one collection device. So we didn't have to have multiple test kits, multiple brands across multiple locations around the world. The Northern Hemisphere in the US, we actually do it out of Charlotte, our office in the United States, and Southeast Asia and in Australia and New Zealand, we'll run it out of our Brisbane office, which is our EasyDNA. So they're the two main hubs for the majority of our test kits for distribution, and the majority of our test kits, which is the one gene type product that I shared with you earlier. The other thing is that we make sure that we manage expectations on timeframes to get results back. This is not like a traditional, say, a PCR or a diagnostic test where you need to know the results in 24 hours. As I mentioned, we're identifying potential high-risk patients 5, 10, and 15 years ahead of time. So allowing 21 to 28 days to turn around results, get results back for physicians is a normal and accepted time frame in this particular space. So we're not at the behest of, to some of the industries which are much, much more critical in some of these areas, where supply chain is absolutely critical, and we need to make sure that we don't miss the next plane or we miss something significant. So supply chain is managed for us a little bit differently, but certainly high on our awareness. So supply chain efficiencies with the simple kit, supply chain efficiencies by having two hubs to service the Northern Hemisphere, Southern Hemisphere are important, and managing the communication around what is the realistic turnaround times for us to be able to get results back to physicians and patients is making sure that we clearly communicate that. So I think that's sort of three key areas that we focus on to manage supply chain.
Okay, great. Simon, I think we'll leave it there. We're just slightly over time. And if anybody's got any further questions, they can reach out to Stephanie.
Fantastic. Thanks, Mark. Thanks for having me.
Thanks, Simon. If you could please stop sharing your screen, because I know Tony is waiting patiently in the wings. Tony, if you want to start sharing your screen, yeah, it's coming through now. And yeah, if you just go to start the slideshow, yeah, there we go, full screen now. Perfect.
Right.
So ready to start when you are.
Right. Mark, thanks very much for having me. What I'm going to present today is actually yesterday's first half results presentation. So I'll just running through the presentation that is on the ASX platform. AI Media is a global technology company. We deliver live and recorded captioning, transcription, and translation, making the world's content accessible for everyone. This half has actually been a pretty fundamental one in terms of live captioning. This half saw the widespread adoption for the very first time of automatic live captioning, and traditionally this had not been an area that AI Media had been in, although over the last 12 months we have actually launched some breakthrough live captioning services. The interplay of the introduction of automated live captioning has been really interesting in this half. We've had some headwinds, as traditional customers have moved to free tools that are on Teams and Zoom. But we're also seeing some long-term tailwinds, and that'll really be the focus of this presentation. And I'll try to wrap it up with enough time for questions. So in terms of the first half highlights, our revenue grew at 29%, although that did include an acquisition. So on a pro forma basis, the revenue was pretty flat. That did take account of a 25% revenue drop for some of that content that had moved across to the free tools. So excluding that part of the business, the rest of the business has actually performed very well. What we have done is we've executed a real shift away from traditional services revenue to SaaS revenue, and that SaaS revenue is reflected in our own automatic captioning products that are called Lexi and Smart Lexi. And so that growth of 98% year on year at a much higher margin, albeit at a lower price point for the customer, helped us to deliver a 78% increase in gross profit compared to the first half of FY21, and saw gross margins increase from 38% to 53%, delivering a $7 million turnaround in EBITDA, and delivering a break-even performance for the half. We have a strong cash balance, and we are restarting our buyback program on Monday. This slide's actually really quite critical. The impact of automatic captioning, or ASR, so it's called automatic speech recognition, has had an impact on the traditional low end or consumer grade end of the market. And it's seen customers who have traditionally been paying up to $100 an hour for captioning move to a completely free tool that, although it has lower quality, the fact that it's obviously free and the fact that it's on demand has led to about a 25% decline year on year in that legacy business. But what we're seeing, and I'll run through some case studies, are actually people then coming back to us after trying these free products and saying that they're willing to pay for higher quality, but it must be on demand. And that's part of the great new product range that we launched in April and May of last year, and we're seeing very strong adoption of that. Our own ASR is something we've been working on since 2017. It is top quality and industry leading. We use multiple underlying ASR engines, which is really critical because different ASR engines perform better in different languages and with different accents. We have our best-in-class AI modeling, which incorporates natural language processing, deep learning, neural networks, and contextual learning all put together. The really key thing, and I'll spend a bit of time on this in the slide ahead, is that the single button on-demand convenience that is a disadvantage for us on Zoom and Microsoft Teams becomes a big advantage for us on our ICAP gateway delivery platform. And this is a platform that has over 95% penetration in US broadcast. It delivers us effectively a defensible moat in the same way as the Zoom and Teams is a disadvantage. This closed loop system is a real advantage for further growth. And we've got some really, really exciting early proof points of that. One of the questions I've had in the past has been, what actually is this ICAP gateway network, and how does it actually tie in with the delivery of automated captions and transcription? And fundamentally, I went to a big event at the Overseas Passenger Terminal in Sydney in December, and it was the first event that people had actually come back after COVID. It was packed. It was an industry innovation awards. We had the minister there. the chair of Tesla. And people, I think, for the first time were actually getting together, and the audio was really bad from the speakers, and they kept trying to hush everybody up in the audience. And there were all these screens all over the room, and there were no captions on those screens, which I thought was ridiculous. And so I went up to the organizers who pointed me to the AV event company, and I asked them why they didn't have any caption, because this is what we do. And they said they couldn't find a way to actually get the captions onto the TV screen, which was really interesting because you know, when you think about actually putting captions on TV, it's more than just generating the speech to text. You know, if you think about the Winter Olympics, the standard default of captions when they come up, auto captions on Zoom or Teams, is white text. Well, white text against the backdrop of the Winter Olympics just doesn't work. And also, if you are preparing captions for display on a TV screen, if you've got someone watching those captions on a mobile device, they're going to be completely useless as well. So what this ICAP network is, and this was one of the technologies that we acquired from EEG, which we bought in May of last year, is actually the connective tissue that links the encoding of a video stream, and there's various options on the left of that screen to do that, be they physical devices, virtualized or cloud-based, ingest that material, send that material through to the engines that generate the speech to text, like Lexi, Smart Lexi, or our premium service, and then have a series of options to then go and display those captions into either TV sets on a large event, or onto a mobile device, or onto an app, or with a separate user interface like our AI Live interface. And it's really putting all of this stuff together that is helping to solve the market problem. And as soon as the really key piece here is that as soon as anyone acquires any of those devices on the left or the right, they have a single button option to add captions and have them displayed appropriately. And that is the on-demand convenience that's delivering us strong tailwinds. So of the sales wins for the half, almost none of this is actually reflected in the revenue for the half, and we'll expect to see this coming in H2 and also in FY23 and beyond. So we've deepened strategic customer accounts with 3 global technology companies, 2 parliaments, 1 international sporting organisation, but critically, those big 4 US TV brands, we have actually migrated across from a human premium delivered service with one of our competitors to AI Media's Lexi and Smart Lexi product. Whereas Sky News, GB News and TVSN are new customer wins to the ICAP network. And we're seeing obviously very, very big brands give us a lot of confidence that we are heading in the right direction. So this is just a little more on that market in transition. So we are seeing those short-term headwinds, 14 to 16 million in revenue lower than FY21, but more than made up for with the tailwinds, which is really great to see. An example of the kind of problems we're trying to solve is this is for one big US sports broadcaster who is expanding their production suite, and they're moving a new subsidiary competition onto an OTT platform. They are using brand new IP video workflows, and we have sold in a solution to them to provide fully scalable and affordable captions on multiple channels using our Lexi and Alta products. What's really exciting about this is the scalability of it. There's almost no direct cost that's kind of going into this particular sale, and we're seeing a lot of trends where existing broadcasters are diversifying and increasing their content as they move more and more of their content onto the online platform. This is a really interesting case study as well. So this is a global technology company who we've worked with for many years. They have their own consumer grade ASR product, but the problem they're trying to solve is actually one of workplace accessibility for their engineers, many of whom speak languages other than English. The solution they are looking to us to provide is actually that end-to-end service of linking up the encoding and the display options, connecting all of their meeting rooms so that whenever anyone has a meeting, it's a single button push. And of course, you know, they don't have those devices, nor do they have the engineering expertise to actually install them. This is obviously a very large installation. And what's interesting about this is it's not going to be a specific use case to a large technology company. This is a use case that's going to be relevant to any large global company. If you think of, you know, even the professional services organizations like the accounting firms or the consultancies, this is actually something that we believe is going to be a real push as companies look for scalable solutions to universal design and making their content more accessible and getting more value from the meetings that they have. And then the final case study is just a really interesting one. So this was a long-term customer we've had in the United States who was paying $99 an hour right up till 2020 for a human delivered premium service. In 2021, they flicked over to the free captions on Zoom. And then in 2022, so just a couple of weeks ago, they switched back to us. As long as we had an on-demand service, which we do, they were willing to pay about a quarter of what they were paying in 2020 for an on-demand service. Even though it was slightly lower quality than what they were paying for in 2020, it was much higher quality than what they get with the free tools in 2021. So it really is a market in transition, but one that we're well placed to take advantage of. The transformation can be seen in this slide here with our SaaS and devices revenue increasing on a pro forma basis by 44% from 18% to 26% of the total, and we will see that trend continue. These next two slides are really giving a deeper dive in the market. So our volume growth in terms of minutes on our ICAP network is growing at around 18% a year, and you can see that that's a network that's quite well established. And then the bottom grey line is our services revenue. And while that's been declining, that decline has more than been made up for in a much higher share of Lexi and Smart Lexi. And the next slide really demonstrates how much headroom we've got. The green there is the penetration of Lexi and Smart Lexi as a percentage of the total ICAP traffic. What's in blue is still being done by our competitors and still with human delivered services. Our competitive advantages remain the same. We continue to invest in our proprietary technology, which provides seamless and secure, reliable performance. That security is critical. All of our customers' data is protected, and we integrate with customer systems seamlessly, do it in every language, and we have local sales teams right around the world. In terms of the financials, I've touched on those highlights already. OPEX, critically though, has been flat, which is starting to demonstrate, and with increasing gross margins, we're really hitting an exciting inflection point of operating leverage in the business. Balance sheet, we've got a strong cash position. There is a current liability in the books on a contingent earnout provision, which we are expecting, should those performance hurdles be met, for that to be pushed out about 12 months as well. So giving us a lot of balance sheet flexibility. In terms of cash flow, positive operating cash flow and some outflows related to transaction costs and some of the buyback. We've continued our growth offshore with Australia and New Zealand now being less than a third of the total, and we're seeing that growth continue. In our product splits, live broadcast has really significantly increased over the year, and that's being driven by that EEG acquisition, but also the increase in live sport, in particular on OTT platforms. And for example, we captioned 60 channels using our automated service for NBC's Olympics coverage on their OTT Peacock platform. We are providing guidance for FY22, so it's revenue of 60 to 62 million, which forecasts the second half about 10% higher than the first half, gross margins of 53 to 54%, and a break even to small positive EBITDA compared to a loss of 8.7 in FY21. Key assumptions there are that our contracted revenue continues to be realized, that our product enhancements are successfully deployed, and that we meet our customer service levels. Risks to this would be any delays in customer onboarding, unanticipated events, or global macro uncertainty. But we've got a reasonably strong and confident view on the last 4 months of the year. What we're also doing is we are investing further in ICAP and Lexi and Smart Lexi, and have launched a preferred partner program. So if you think back to that use case of the big event, we are partnering now with audio-visual companies to ensure that they have those devices that they can bump into an event and ensure that those captions can seamlessly be delivered, and of course provide them all of the necessary training that they would need through that. So this is really, as we're at the very early stages of the adoption of ASR, and we have a plan through to 2025 to really see this next phase of technology development, establishing the ICAP network as a global standard, driving growth in higher margins, growing and diversifying our customer base, and enhancing our product suite and technology to continue to be the market leaders in that space of professional live automatic captioning. And Mark, I'll throw over to you for questions.
Thanks, Tony. Great to get the update. I just wanted to see, have you got a sense of where you are in the transition of, customers who've, previously been on the paid human-powered version, moving to the free and coming back again? I'm assuming some will kind of just persist with the free and not kind of move up to the paid version. But do you think you're kind of 50% of the way through this transition, and it'll have kind of whatever is going to wash through in the next 12 months, or is it a 2-year kind of process? Can you give a better sense of where you are?
No, I think you're probably right. I think it's probably about halfway done already, and I think the rest of it will wash through in this calendar year. One interesting thing to call out there, Mark, is that I'm not expecting the customer mix to be the same in this new world. So, as we're selling to, baseball organizations, we're not necessarily supporting individual workers who may work for the baseball organization. In the past, we would have supported, an individual student at a university, and they would send us all of their captioning sessions for the semester ahead. Now what we're doing is we're providing an on-demand service in every single lecture theatre in these universities, and so the level of conversation that we're having is at a much higher level up the food chain, and we're providing enterprise-grade solutions that are delivering true universal design, and not just something that's a kind of an appointment booking. It's actually just a click to caption kind of world. And I think there's a lot of interest in making sure that companies comply with disability legislation, which is increasing right around the world, but also the flexibility that we can offer with our Lexi product means that our customers themselves can tailor the custom dictionaries really easily to get the best out of the ASR engines. And an example of that is, if you've got an organization that's having a meeting about a particular product squad, they can very easily put in all of the names that they're using for their products and their tools and their technology and their team, so that when those names come up, they will be reflected very, very accurately in the text. And we've got a great example of that on our website for the Smart Lexi demonstration, and it relates to a weather clip from Perth, and you talk about a cyclone called Seroja. The basic ASR has no idea what that is, but as long as you've actually put a few words in the dictionary before the meeting happens, then the outcome is almost as good. Not quite as good, but almost as good as those human delivered services, and certainly a lot better than the free tools. So it is a market in transition, but what I'm really happy about is we've hit a lot of those headwinds really quickly. So as soon as those free tools became available, we saw a massive drop of about 25% immediately. And then it's obviously been a slower build with new customers, but we've managed to fill that entire revenue gap in the first 6 months. So, while I think that the transition still has halfway to go, I actually think that we'll be accelerating the tailwinds as I guess we're predicting for the second half.
And then can you give us a sense of, when people move back or new customers come on to the SaaS solution, the split between who's taking Lexi and then, or the more expensive Smart Lexi option, and just, what the price differential is for somebody who's like weighing up which one to go for?
Yeah, it's case by case. So Sky News, for example, when we migrated them from the premium to the automated, chose all Smart Lexi. GB News chose 6 hours of Smart Lexi and 18 hours of Basic Lexi. And NBC have also used a mixed mode where they're prioritizing the Smart Lexi on the most important content. And in terms of the budgets, if the human delivered captioning is at $100 US an hour, the basic rates for Smart Lexi is about $50 an hour, and Smart Lexi is $50 an hour, and Basic Lexi is $25 an hour. So significant savings to the customers. And then a lot of those are now using the technology to caption even more than they were before. So for example, Sky News went from 7 hours of captioning to 24 hours of captioning through this transition. So we didn't actually see a revenue hit despite the fact that we were charging lower rates per minute.
And then in terms of new customers, I know you referenced it there, I think it was maybe the second last slide, Australia becoming a smaller proportion of total and rest of the world growing. Can you give us a sense, is it the US, UK, because they've kind of opened up a bit faster than Australia post-COVID, and people are now kind of got confidence in pushing the go buttons on it? Or is it one particular vertical? Let's take
it's pretty broad based,
where there was no fans in there, so everybody wants to watch games online or across the TV because they couldn't have been in stadiums for the last 2 years.
Yeah, no, I think, look, it's been pretty broad based. In terms of verticals, I mean, we are seeing verticals move globally. So, we won the UK Parliament last year. We've won the New South Wales Parliament this year. There are more parliaments knocking on the door based on, that kind of success. The OTT platforms are now all sort of migrating to a common standard of 2110, and the Alta product and Lexi are designed perfectly for that. And you also look at municipalities, of which there's thousands of them in the United States, who sort of have mini broadcasting studios as well. So, I mean, that, you know, it's very broad based. The only reason that Australia's kind of going backwards as a share of the total is that the total's growing, and growing faster than Australia, because we've got pretty good penetration into Australia, which is a market in which we've been operating for 20 years now.
Okay. Tony, I think we'll leave it there because we're just pushing up exactly on time. Thank you very much for coming in and giving us the update. And I'll just say to people, I know we didn't do it today, but if we go back to when Tony first presented, we actually did the live captioning on the video. So if anybody wants to see another case study, they can go back and watch Tony's first presentation at Coffee Microcaps.